So I'm looking at the markets, and Netflix just released their earnings, and you can see that it dropped 25%. So even though it is at a discounted stock, because the growth numbers are not great, there's actually a decrease in subscribers count. So that led to a 25% drop for Netflix. So that's actually pretty crazy. And I was quite shocked by how much Netflix has dropped, given that it has previously dropped a lot. So let me show you what I mean. So I gotta say, this is one of the crazier things that has happened, given that I have been tracking the stock Netflix as well. And if you have been following, Netflix, you know that Bill Ackman previously bought, and management has a very positive view on it, and they also try to increase price as well. So a lot of things seems to be going in Netflix's favor. But earnings comes around, and here you get Netflix drops 25% after it loses 200,000 subscribers. And I guess, it's a combination, of course, the industry itself is very competitive. And also, I guess they're looking to raise prices. So some people are canceling because they think Netflix is too expensive. So I'm recording this, almost midnight. And they just released the earnings today. So you actually don't see the price change on this chart here. But what I can do is I can bring you to NASDAQ. And if you go to NASDAQ and you look at the last sale price, so the after hours, where the mutual funds or the hedge funds are trading, then here you can see the latest price was $258. So that's actually significantly lower than what you see here, which is $348. So when you look at what happened with Netflix, let me just kind of zoom out a little bit. I'm using a weekly chart. So here you can see historically, Netflix has actually a pretty strong trend. And if you go to here and you look at the highest high, which is November 2021, just before the technology market crash starts happening, it was at $684. So that means it actually dropped all the way to 350 or so, which is basically 50% drop. So you would imagine that Netflix is already quite cheap. And after the earnings release and they have a lower subscriber count, it dropped another 25% from that. So right now it's actually all the way down here, which is $260. So when you look at this drop, this is almost a 70% drop. Let me just do some quick math here. Yeah, around 60 to 70% drop from the high. And this is actually comparable to the year 2000, the dot-com crash. So when I was studying the dot-com crash, you'll find that a lot of technology stocks are actually dropping by 60 to 80%. And that includes Google, Apple, Amazon. Obviously, the drop is caused by a combination of factors. Well, first, historically, Netflix actually doesn't have a decline in subscriber growth. And the decline in subscriber growth is really a reflection of how competitive the streaming industry is. You have Disney Plus coming in, you have Hulu, you have Amazon Prime, you have all these other no-name streaming services as well competing with Netflix. So if Netflix is moving into the content creation direction, how can they sustain the competitive advantage per se over a long period of time when other streaming services can also create their own content? So we're really just going back to the cable world where you have like different cable services and then people start pirating instead of subscribing to these services. So I think that's what we're seeing right now. Now, another thing I think we'll see in the last earnings seasons and this earnings season is really the macroeconomic environment being more difficult. Like previously, interest rate was low, things are good, liquidity was everywhere, and Fed was really helping the economy. And after that, now, Fed is trying to reduce the balance sheet. They're offering less loans. They think the economy is strong. And that is actually leading to a significant decline in the equity market. So when you're investing in this kind of climate, you need to be extra careful. And more importantly, you need to pick your stocks very carefully. And even if you pick a very good stock, it might not go up immediately, which is why long-term investing is very important. And if you're in a bear market or a short-term bear market and you focus on short-term trading and you use some risky option strategies like short-term options, then it's actually very easy to lose money. And I have been testing between long term, short term, medium term. Out of all of that, it only makes sense to use long term option strategies to protect yourself, because when you are encountering something like a bear market, being a short term trader, it would completely shatter the way you think about the market, and you would think your strategy doesn't work. And when you're looking at your strategy, you will go through ups and downs. So you will have a period of it going down, and if you're a long-term investor, it's a lot easier to stay on course, and it's harder for you to make a mistake, which is, what people panic sell, so on and so forth. Now, if I bring you back to one of the stock picks I offered earlier, in fact, it was like one of my very first stock pick on this YouTube channel, Disney, to help you make $10,000, then you'll find that if I'm looking to invest in Disney when it wasn't a discount back in March 2021, Disney has actually been going down for 13 months straight. And it has dropped from $200 to $130 something, which provides you with a significant discount. So when you're investing in a bear market and you think very short term and you think that, hey, I'm going to put money in Disney, like $30,000, hoping to make 30% return, it's not going to happen immediately tomorrow. That's why, in Investing Accelerator, I focus a lot on teaching you how to think long term, and you need to plan long term first, so then you can work backwards to see if you can get a faster profit. So when the market opens tomorrow, which is April 19th, you'll find that, hey, Disney is actually dropping as well because of Netflix. So that's why in the previous video, when I was saying Disney is at a discount, it's a good buy, you want to prepare and have the ability to average down, especially you're in such difficult market condition. And that's why risk management is very important. And I stress that a lot in Investing Accelerator. We also talk a lot about position sizing and, when you should be aggressive and when you should be conservative. And for the last couple of months, or actually like a couple of quarters, we have been really conservative. We have been trying to be as conservative as possible. And even so, you will find that my portfolio fluctuates quite a lot. And in reality is not because I want my portfolio to fluctuate quite a lot, it's because the market itself is quite volatile. It doesn't mean there are no opportunities in the market, but it just means that you need to be smarter about it. So let me bring you to another example. So if you go to one of the stock here, NVTA. So this is a stock I actually analyze in Investing Accelerator, and a couple of students asked me to analyze it as well. And the conclusion is always, well, I don't think you should be investing in this stock unless you know what you're doing and you know the products very well. Because when it comes to investing in biomedical technology stocks, it's actually quite difficult. It's just because of the nature and the kind of company it is, makes it very difficult to invest. And unless you have some superior information, maybe you work in the industry or not, then it's very hard to get ahead compared to like other hedge funds and mutual funds or whatnot. So obviously, now we're stepping out of the post-COVID world, and here you can see since January 2021, the stock has been dropping. So it used to be $60, at the absolute highest high. And it has been dropping and dropping and dropping and dropping, and now it's $6. And one of the problems when you're investing in a high-risk company like that is the ability to recover. So when you're looking at the ability to recover, meaning that after a crash has happened, can the company, well, A, survive, of course, and can the company go back up to its previous price? And that's really where the long-term trend becomes important. So imagine you're investing in a stock that is very cheap, $6, NVTA, fantastic. It dropped 90%. So you can't really lose, right? But, if the trend itself is not very strong, then is there really a driver that makes NVTA goes back? Versus if you're investing in something like Disney and the trend is strong and you consider a lot of different factors like I did in the previous video on why it will go up, then the company has a driver which causes the stock price to go up. Which is why in Investing Accelerator, we actually focus on really, 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 really low risk opportunities, and then we use options to multiply our return. We don't focus on really high risk opportunities and then we use options to multiply the return further, because it works very well in the short term with bullish markets and when everything is going well. But when things are not going well, like now, then that's when you would appreciate that, oh my God, I should have invested in discounted stocks. I guess this realization is really the result of years of testing and investing in the market and realizing that you need to start thinking from how you can protect yourself from losing money first before going aggressive on growth stocks. So when you're looking at your portfolio, you can look at it today and you take a look at your stock picks and see, hey, maybe it's all in technology, maybe it's all in high growth companies that actually don't make money, maybe they don't even have revenue, or you don't even know what kind of products they have, then you would think to yourself, well, are you taking too much risk? Can the company recover? Can the company have the fundamental or the business model to support its recovery? And if there isn't, then it's going to become really difficult for the company to recover. Like they might run out of cash, which actually I invested in companies that ran out of cash before. And eventually the company actually went bankrupt. And I think what we're going to realize in the next 6 to 12 months is that as the interest rate is increasing, it's going to become increasingly difficult for companies to raise capital, whether that is raising capital through equity, which is shares, issuing shares in the market, or raising capital through debt, which means getting a loan. So you can imagine if the interest rate today is already like 5% for a mortgage, and the company needs to use 7% to raise capital, then they're not going to be able to raise that much, because when the bank does their calculation, debt to service ratio or whatever, they aren't going to be able to raise it. And if the stock price is tanking, which the market thinks they have difficulty to raise capital, which is why the stock price is tanking, then they aren't going to be able to raise as much equity as well, which further dilutes their shares. So if you're investing in high-risk stocks, the share price tanked, and you're wondering if you can recover, then I think you should start looking at how much cash they have. Because when you're looking at high-growth companies like NVDA, but they don't make money per se, they're going to be running out of cash eventually. Whether that is within 4 quarters or within 8 quarters, which is 2 years, they need to raise cash somehow, and that's going to eventually lead to a dilution of the shares. And there will be companies that are not able to raise that cash, so we should see some companies that go bankrupt in the next 2 to 3 years, because I think as of this point, unless Fed changes their perspective and go like, hey, I know you guys are struggling, let me bail you out, or I'm going to lower the interest rate again, I think some companies are going to go bankrupt. And I think it's not unreasonable to say that companies that are loss-making, they're not growing as fast, or they're not able to justify their growth curve, and they don't have that much cash, took on too much debt, will be going bankrupt. If you ask me, hey, Eric, what could I have done to prevent that from happening to me? And it all comes back down to fundamental analysis. And a lot of people skip it, like a lot of people, they just look at technical analysis because they want short-term profits, short-term gains, they want to make money fast. But when you get in trouble, you need to go back to fundamental analysis. So if you knew like there is a chance of you getting into trouble, then wouldn't you look at fundamental analysis first to protect your downside? So that's why fundamental analysis is important. And I do understand it is difficult. Like for a lot of people, it's not easy to use, which is why, as a CPA, I teach people how to invest and use technical analysis and fundamental analysis together. So you're just not learning one side of the equation, you're learning the entire investing strategy from beginning to end. And even so, in a difficult market, the best you can do is to protect yourself by investing in really safe companies when they're at a discount. And investing in discounted companies is such an important concept in terms of risk management that you would appreciate it once you start seeing a bear market. Like if you start investing maybe 1 to 2 years ago, you've never seen a bear market, and now you see one of like a major crash happening once every 10 years, then suddenly, hey, you realize that risk management is very important and it can only be done before the crash happens. Once the crash happens, well, like Netflix, you're down 80% or 60 something percent. So there's nothing much you can do other than waiting for it to recover. If you invested in the stock at a discount, then fantastic. You should recover a lot faster than other people. If you invested the stock at all-time high, then, well, you're going to be stuck with the stock for quite a few years. And just to give you some perspective on the 2000.com crash for something like Apple or Amazon or whatnot, from the highest point of the crash to the dip, consolidation, and then going back up to the previous highest point took around 3 to 4 years. So you do need to have that long-term view, and it does take time to recover. So I think the recovery phase will eventually come. We don't know exactly when, which is why, I track the market on a daily basis for a couple of minutes. And most people can just use around 1 to 2 hours a week to track the market if you're using the investing accelerator approach. And that should be sufficient, because if you're working a full-time job, I know you're super busy, so then you wouldn't have time to track the market. So I guess after you watch this video, it does pay to take some time to think about, this earnings season. And we're really in the beginning of the earnings season, so we'll have to observe very carefully in terms of what's happening to the entire market and to the specific sectors where you have stocks as well. So yeah, we'll keep track of it closely. And if this is the first time you come to my channel, then welcome. You can watch some more of my other videos as well. And if you like this video, you can click a like and subscribe. And let me know what you think about the market and what will happen to Netflix. Yeah, I suspect a lot of people are losing money on Netflix, and maybe only a small portion of the people that are either shorting the market, and shorting Netflix will make money, and or if they hedge before the earnings. So it is a difficult market, and I think it pays to be conservative, manage your risk, and people who are chasing short-term gains can easily get burnt. So yeah, try not to do that. And I'll see you in the next video.